Okay, following on from our discussion regarding the time period assumption, the revenue recognition principle, as well as the matching or the expense recognition principle, then the need for adjusting entries is now is happening. Okay. So what is adjusting entries? We need it to ensure that the revenue recognition and expense recognition principles are followed. Okay, because we have time periods and we do our reporting according to time periods. Sometimes, let's say for example, we want to produce a financial report on June. Okay, we want to produce a June financial report, but then in June we have actually rendered our service to our customer, but the customer has not paid in cash in July. Therefore, at the end of June, before we prepare our financial reports, we need to do adjusting entry to ensure that we have recognized the revenue in June and not wait until July that we receive the cash that we want to record our revenue. Okay, so that is why we need to do adjusting entries, and it is necessary because the trial balance may not contain up to date and complete data. Like I said, if we have rendered our services in June, and at the end of June we prepare our trial balance, that trial balance will not include the revenue or the service that we have rendered to our client in June. Okay, therefore we need to do the adjusting entries. It is required every time a company prepares financial statements. Okay, like I said, if we prepare our financial reports in June, then we need to make the adjustment. If, for example, we do our transaction adjusting entry, or we do our financial statements at the end of December, but then we are still in June, and we have received our we have made the render our service to our customer and we have not received the payment. If we have not done the adjusting entries, it will not affect our report yet, because we have not done our report. Our report is in December, but when we are preparing our reports for a certain date, then we must make sure that all the needed adjusting entries fall before the end of the period that we want to report. We will include one income statement. Okay, all adjusting entries will generally involve one income statement account and one balance sheet account, because adjusting entries, why do we do it? So that we ensure that all the revenues and all the expenses are matched to the proper periods, and revenue and expenses are shown in income statement account. And because of the adjusting entries will involve updating our liability or our asset, therefore it will be affecting the balance sheet account. Okay, at least one balance sheet account.